banking story is a story that traditionally for many decades is one that is an instrument, a facilitator for other business. And so we like to look at banking as a modern marketing bridge to better life insurance practices. And it is with great pleasure that I see so many awesome faces from Equitable Bank. This is the Equitable Bank Fall webinar. We have a great team. We're going to cover two major topics today: CSV, IFA lending. And there's lots of opportunities with CSV, both as a way to start the sale, as we know with an IFA, as well as later for existing policies, later in the life of a policy. And so after that, we're going to cover reverse mortgages, which is just a fabulous new opportunity for our industry. I can't think of a solution or a product that will put you right in the thick of it in terms of all of the insurance opportunities that are going to be occurring and that are there between the three generations: the elderly parents, the adult children, and the grandkids. Massive opportunities in there. And a great phrase that I'd like you to remember is one that I've learned from Don Hart, which one of those opportunities on the insurance side will be a little extra insurance to cover the rising balance on a reverse mortgage. And Don Hart has introduced me to the phrase permission to spend. Many grandparents want to do lots of things for their cash-strapped adult children. And then, of course, that allows the adult children to do things for the grandkids or for their grandparents. The strategies are numerous, but that permission to spend concept is a great one that I'd like you to keep in mind as we listen to the reverse mortgage portion of this presentation. So we have a great team. We have Michael, Johnny, Mozzie, and a second Michael. At this point, I'd like to thank Equitable Bank for joining us. This is a great lineup, Michael, and please kick it off.
All right, perfect. Well, thank you very much, Vic. And if you just bear with me, allow me to share my screen. Well, thank you very much, everyone. I am Michael Piltz. I am the head of national sales on the insurance lending side here, as Vic alluded to. I spend a lot of time actually speaking with Vic, not as often as either of us would like, or certainly I'll speak for myself as much as I would like, but it's always a pleasure to speak with him and to have the opportunity to get in front of folks like yourselves. Also joining me today is Michael Cumberbatch, who's our head of business development and relationship management on deposits. He will be speaking to you about our reverse mortgage product. And then I have two colleagues from my team directly, Mozzie Chelia and Johnny Lee, who are BDMs for different areas of the country. So certainly if you're located in British Columbia and Alberta, Johnny is your man, so to speak. And if you're in Ontario, Saskatchewan, Manitoba, or the Maritimes, basically not Quebec, BC, or Alberta, Mozzie is your individual as well. And certainly you should always feel free to reach out to me. I am always happy to talk to advisors about deals, opportunities, our product lineup, any such thing. And we'll generally walk through the earlier stages of deals and then very much look to align you with your associated BDM. So that being the case, let's get into the thick of it. I have here's the agenda for today. So we'll all talk to you a little bit very briefly about who Equitable Bank is, because we certainly understand that we don't have bank branches on every corner. So not everyone is hyper aware of who we are, but it's certainly important for you and your clients to understand that we have the capability, the expertise to provide meaningful solutions, whether it is on the insurance lending side, whether it's traditional CSV lending based on in-force insurance policies, or certainly where the bulk of our business on the insurance lending side has come, and in the more recent years is on the IFA side, because we have a very unique and compelling IFA solution as well. I will hand it off to Mozzie and Johnny to continue that discussion before they hand it off to Michael Cumberbatch. So who is Equitable Bank? So we are, in fact, Canada's 7th largest independent Canadian bank. We are over 50 years old and have well over $125 billion in combined assets under management. We're a Schedule I bank. We've actually been rated Forbes World's Best Banks list for the past 3 years running, and I would strongly suspect when the 2024 list comes out, we'll be there again. I do want to point out, certainly given the audience, as many of you would be aware, that the relationship between Manulife and Bank. I'll point out that Equitable Bank, once again, is its own independent Canadian, publicly traded Canadian bank. We do have a relationship with Equitable Life only in as much as we lend on their policies and are willing to work on Equitable Life policies, much as like we are with 9 other, so 10 in total, insurance companies currently we have relationships with. But aside from that, very separate. The similarity would be in name. And again, given the, certainly your understanding or probably likely understanding of Manulife, I do want to point that out. And I would say that, not only are we publicly traded, but as of, I think 3 years ago now, Equitable Bank was actually added as a component stock to the broader TSX index, which in my view, I always like to say, speaks to Equitable Bank's growing presence within that broader Canadian financial ecosystem. In terms of our lines of business, Equitable Bank is, certainly a going concern with operations in many areas. Certainly, we're very strong on traditionally, because this is where the basis of our business was from the get-go, was with real estate lending, both single-family residential as well as commercial lending opportunities. We do have unique areas. We own an equipment leasing company, and we certainly have a specialty finance division, which I would always point out with, for folks like myself, I may, connect people or unique inquiries, I'll say, a little bit outside the box inquiries with our specialty finance division. Those are the guys for non-off-the-shelf solutions. They are the brain trust that will look at the opportunity, compile, see if it makes sense, and put our best foot forward there. Certainly, there's the insurance lending division, as well as our reverse mortgage area. Equitable Bank is obviously a deposit-taking institution. We have GICs, high interest savings accounts, and then EQ Bank is our direct-to-consumer online banking platform. When it comes to all the other lines of business for Equitable Bank itself, not EQ Bank, we very much respect the dedicated distribution channel. So when it comes to the insurance lending arm, our clients, the way I view it, are you yourselves. You, as the insurance advisors, are the clients for insurance lending. We look to work with you and provide solutions to your clients. For the mortgage side as well, we don't do direct consumer mortgages, but on that side, certainly respect that channel, which would be mortgage brokers and such. So we definitely always focus on the relationships and respect the relationship that you have with your clients, and see ourselves as a trusted partner to add to your toolkit, your solution offering. Finally, Equitable Bank, we really bill ourselves as Canada's challenger bank, which really is a more unique concept within Canada, but worldwide, definitely in Europe, somewhat in Asia and Australia. This concept of a challenger bank is more widely known, and it's really just about rethinking conventional approaches to banking, staying nimble, being focused on service, and really just delivering, again, unique solutions. And I think you'll see that as you go through the presentation with reverse mortgages perchance, right? Like there are only 2 banks in Canada that offer a reverse mortgage solution. And I mentioned earlier with our IFA solution, like we are very unique in the way we approach IFAs, certainly with regards to how the other banks in Canada approach it as well. And as you can see at the bottom, this is more than a tagline. Service really is our passion. You will see as you start to engage, and hopefully if you're in touch with your colleagues who are already working with us, they will support this contention that we are very focused on delivering a good experience, providing you and your clients with all the necessary information and then some to make you comfortable in choosing to partner with Equitable Bank. So I'm going to hand off to Mazi now, who will lead the beginning portion of the discussion on what we do on the insurance lending side.
Again, my name is Mazi. I'm one of the business development managers with the insurance lending team. So have some info for you on our product offerings. Like Mike said, each product definitely has a unique value proposition. And so I'm going to get into that. But before we do, I'm going to talk a little bit about the three primary options for life insurance in Canada and why specifically we work with whole life insurance when we do these types of loans. So with whole life insurance specifically, there is a cash component, and that cash surrender value can be surrendered before death. And the big piece about that is that the cash surrender value is guaranteed once it's credited. Therefore, there's no market risk, and that's why we can lend against it. On the term life insurance, there is no cash component, so there's nothing for us to use as collateral. Universal life is interesting because there is a cash component, but it does fluctuate with the market, so there is a bit of market risk there. What I will say on the universal life side of things is that we are having conversations around doing some type of loans and creating some products for universal life, but that's something that's being discussed for some time in later 2025. So stay tuned, but we will focus in on the whole life insurance side of things. Mike, if you want to scroll over the next slide there for me. Oh, so honing in on the whole life insurance side of things, whole life is separated between the cash surrender value and the death benefit. We're going to start off right now by saying we're not so concerned about what the death benefit says. We are solely concerned about the cash surrender value, and that'll be a combination of both the guaranteed and the dividend value. And again, that's because that's what we use as the security for our loan. It's that CSV portion. So let's dig deep now into our three product offerings. So we have three great products, and these can be structured both corporately or personally. Essentially, the way it would work is if you have a corporate policy, it'll be a corporate loan. If it's a personal policy, it'll be a personal loan. Now, each product is great because it offers tax-free funds. And so let's talk about the specifics of each product individually. The CSV Flex is designed as our insured retirement plan. It's designed for people who are 50 and above. The cool part about Flex is that the interest actually capitalizes. What this means is that there's no payment requirements, whereas in the other two products, there is monthly interest payment requirement. Now, CSV Flex is calculated on an individual basis, and this is to reduce default risk and margin calls. I do have a great graph for you on a few slides from now, which I will show you exactly how it is that we calculate the approval amounts for CSV Flex. But before we do, let's talk a little bit about CSV Max and IFA. So a CSV Max, in a similar structure, it does look to target about approval amount at about 90% of the CSV value of your policy. We can't always get to 90%. We always say, send us policy information and we will look to give you quotes as soon as we can. But we do see access of up to 90%. There's no age requirement on CSV Max, but you are required to service monthly interest. What this means is that there will be some form of debt servicing or liquid asset tests, whereas on a CSV Flex, because there's no requirement to service any type of interest, there's very little underwriting involved. Johnny will get into the weeds of that, but specifically, CSV Flex is fairly straightforward in terms of underwriting. Basically, just know your client stuff, and then CSV Max, just a little bit more in terms of liquid assets and potentially some income. The immediate financing arrangement is where we have a very, very unique value proposition. And that's because we can get the client 100% of the premium paid in without the need for additional collateral. We can do this as long as what we inevitably call the 70% rule, which means if we're 70% secured with CSV relative to the premium paid in, we can give you 100% of the loan, no additional collateral. So for example, let's say you have a $100,000 annual premium, the year-end CSV is $70,000. We're willing to take $30,000 unsecured there and give the client the full $100,000. We won't take any collateral, and we never ask for any additional collateral. So in hypothetical terms, let's say you have a policy that has $100,000 premium paid in, but for year one CSV is only $65,000. In that case, we can't get you the full 100,000. What we would do instead is take 70% relative to that CSV. So you'd go $65,000, which is the year-end CSV, divide it by 0.7, you'd get something like $93,000, $94,000 in year one approval. The beautiful thing about what we do is that at a later point, when CSV does cross that 70% rule, we can not only get you the full premium paid in for that year, but we also do what we call a catch-up period for the year after. So in that case, let's say year two rolls around, you've paid an additional 100,000, so you're $200,000 in, but the CSV is now 140,000. You've hit that 70% threshold, so you're going to get 100,000 approved in the second year, but you'll also get the 6,000 or 7,000 out of pocket from the year before. Mike, if you want to just go to the next slide here. So how exactly can clients optimize their financial plans without breaking the bank? It's exactly with these products here. Mike did allude to our approved insurance carriers. They are here. We are approved with all 10 of these carriers. We haven't had any issues with anything outside of this. So if you do happen to work with any other insurance carrier, let us know. But yeah, I think we're pretty solid here. We can move on to the next slide. So this is a great slide that shows a visual illustration of how CSV Flex works. So you can see the yellow line is the CSV amount over time, and the blue line is what would be our loan amount over time. What you'll notice is at age of mortality, the CSV amount and the loan amount actually cross paths, and that's because that's exactly how we would underwrite it. Basically, the way we underwrite a flex is we have to assume that as of the current year, they're going to capitalize interest until age of mortality. So we have to look at the future, the expected CSV amount at the future time, and sort of reverse underwrite so that the client can avoid any type of margin call. And we have to, the way we actually underwrite it is based on current interest environments. What does this mean? It means that the CSV Flex product is fairly rate sensitive. So if interest rates are very, very high, the growth in the loan is going to grow at an exponentially faster rate than it would when interest rates are a little bit lower. So over the past few years, for example, interest rates have been a little bit higher. We've seen a little bit of a decline in the amount of Flex applications coming through. But what we expect is as interest rate continues to drop, and we've already seen it, Mike, Johnny, and myself have already seen it, the Flex applications will start to come through because there's value in having a product that the client has to pay service nothing monthly. So if we go to the next slide, is a visual representation of the CSV Max product. So with CSV Max, you are servicing monthly interest. So as the CSV grows, there's also opportunity for the loan itself to grow. So similarly, you'll see the yellow line here being the CSV, and then there's that gray line. What you'll see is these indents as it goes up. So anytime that the CSV has grown at a significant amount, you can actually come back to us and do what we call credit limit increases. And we'll again redo our calculations and see how much we can get you on this particular policy. So if you want to go to the next slide, now let's dig deep into the immediate financing arrangement. Now, again, the IFA allows the client access to up to 100% of the premiums as soon as they're paid in. But there are significant benefits on multiple facets here. And that's because an IFA can help you structure your retirement plan to recoup more value of your policy. It can be an effective tool for tax planning. We always say we're not tax professionals, but there's definitely deductions that can be made there, whether you run that corporately. Have that conversation with your accountant, then re-engage with us. We're so happy to, everyone's always super happy to find out about the benefits of running these policies and then doing the IFA. The key piece of an IFA is that a lot of times clients experience what we call premium hesitancy. So what that means is a client can be a little bit scared to pay the premium out of pocket without knowing that they're going to have that money to reinvest in their business, preserve cash flow, or invest in any other business venture, for example. An IFA allows a client to remain liquid while protecting their loved one, and then at the same time, the policy continues to grow, things to that nature. Now let's talk about how exactly does an IFA work. Now, an IFA is essentially going to work with a high net worth client, going to buy the life insurance policy. They're going to pay the first premium and then assign it to a lending institution who gives them 100% of the initial premium back. Okay. The next piece is going to be over the policy owner's lifetime, they can access tax-free cash while the policy continues to grow. During the policy owner's lifetime, they will get the policy will continue to grow, and then they can come to us each year as they pay the premium and come back and get the next advance in terms of loan amount. The final piece will be kind of a loan payback period, and that's going to come in one of two ways. It's going to be either there's some form of liquidity event and the client wants to collapse the policy, the CSV is greater than premiums paid in, etc. Whatever the case may be, there's no penalties to paying out the IFA loan at any point. We just have to be made whole. The alternative piece would be if the policy owner were to pass away, the death benefit would pay us out, and then the beneficiary would receive the remaining balance. So what an Equitable Bank IFA might be suitable for clients who have a need for a large life insurance policy, they're creating a longer term retirement plan, and are looking to structure their estate planning. So we've talked a lot about all of these benefits, but again, I'm just going to move forward because I feel like we've covered a lot of these pieces here. So kind of as a big recap, why an Equitable Bank IFA? Again, it's access to up to 100% of the premium as soon as it's paid in, up to 30% unsecured, and we never take additional collateral. The key piece that I haven't talked to yet is the competitive rates and fee. So pricing is provided on a loan by loan basis, but you can generally expect your starting rate to be between prime plus a half to prime plus 1%. The 1.5% is so potentially for slightly lower than our 100K minimum. So on IFAs, we do have a minimum premium requirement of 100,000 or more. We used to be a little bit lower, and we will work with you, let's say, in certain instances where you do have policies that are slightly below 100,000, we could look at them, but it is on an exception basis. So we can maybe position it if there's other policies that can be combined, things to that nature. But starting rates typically between prime plus a half to prime plus 1. There is lower bands at prime and even prime minus 0.35 for specific policies. There's various drivers to rate, and that's going to be things like size of premium, CSV amount, years the policy's been owned for, and who's the insurer. These are all things that contribute towards rate, and we're always happy to run quotes for you on any types of sales illustration or even in-force, whatever the case may be, and we can get you that information. The other key piece I wanted to mention was the application fee, which is the initial application fee being the greater of $1,000 or 25 basis points of the annual premium. What this means is if your annual premium is $400,000 or below, it'll be $1,000 for the application fee. If the annual premium is $400,000 or above, it'll be 25 basis points of that annual premium. Beyond that, Mike already alluded to that. Service is our passion, so we are very advisor-centric. We're always willing to work with you in step-by-step approach. Especially if it's your first deal, we'll definitely help you. We have great softwares and great underwriters that'll be with you to the end. And then beyond that, I'm going to sort of step off here. I'm going to hand things over to Johnny, who's going to get into our IFA product overview.
Thank you, Vic, for hosting such a webinar. I can see people are starting to ask questions regarding to our IFA. That's good. So we have some time saved up by the end of the session. So now we're getting into Equitable Bank's IFA product overview. So we do take policies from personal and corporate, and we take CSV for security. And Mazi just mentioned we are one of the banks that allows us 30% unsecured portion. I do want to ask one point here is we do allow a gap up to $1 million. So I see Dan asked a question about the interest payment. Our interest has to be served monthly. So client has to pay interest every month, and premium frequency of the policy has to be annual. So if you have a policy that is monthly pay, we can always try to change it to annual pay before we do an IFA, right? And for repayment, our IFA works more like a line of credit. so it's revolving. So client could pay back any time without penalty. It's just the first funding date, we have to issue all the IFA funds out. And if client wants to pay back, and client can always take it out. So rates, we mentioned our rates is range from prime plus 50 to prime plus 1.5. I don't really see prime plus 1.5. And in terms of rate, our rate depends on the size of the loan and how secure it is. So application fee, Mazi mentions $1,000, 25 basis point. So we do charge a credit limit increase fee. That's $500 flat. Mike, could you please go to the next slide? So we have a couple ways to qualify for an IFA. So here, for example, let's just have a 100K premium IFA, for example. So we can either qualify based on client's net worth or client's income. So for income, that's easy. That's 45% max TDS or 1.05 DSCR for corporates. So if client couldn't show enough income, we can always check out client's net worth to make it work, right? So I give you one example here. So for 100K IFA, we can take 250K liquid asset and 800K in tangible net worth, so if the policy premium hasn't been paid. So the other, if you look at program 2, that shows 20x annual premium in tangible net worth or 10 times annual premium in minimum liquid asset. So for 100K IFA, if client can show 10 times annual premium, which is $1 million in liquid asset, we can always make the IFA work. For liquid asset, we can take bonds, GICs, TFSA, RSP. So for RSP, we do take a discount of 70%. Okay, documents. So we do have everything listed on our website. So basically, if the policy hasn't been enforced, we can always start with a sales lead illustration. So me, Mazi, Mike, our team can give you a high-level quote on how much client can get and what's the rate's gonna be. So policy illustration, application, and ID. And if for personal, we can also get clients most 2 years in 08, most 2 years of tax returns, 3 months bank statements. For a liquid asset, we take investment account statements and proof. For tangible net worth, we take proof of property ownership. So corporate IFA, we need accountant prepared financial statement for most recent 2 years, and the accountant prepared T2 tax returns and 3 months bank statements. So we mentioned credit limit increase, that's CLI process. So for IFA, for the first year, we need to do full adjudication. And for second year, third year, that's more straightforward process. As long as client credit score doesn't drop 100% points or bigger than that, and client can basically fill a CLI form. That's basically a self-declaration of their financial position hasn't changed. And as long as client show premium paid to date, and client had for the past year has good repayment history, we can process the credit limit increase. So for our CLIs, we do have a $500 annual fee. So for year 4, we need to do adjudication, and after that will be until year 7, and we don't have any. We don't need to do adjudication. So let's do a recap why an Equitable Bank IFA. First, the client can get up to 100% of premium with no additional collateral needed, and we offer competitive rates and fees, and we are advisor centric. For example, I know Mike has 20 years of experience, and Mazi, Deborah, and we are all trained to help you with your clients' IFA needs. So who are the suitable clients for insurance lending products? Usually we say that's the client who want to have the cake and eat it too. So IFA product is typically for an ideal situation for clients who have a large insurance needs and thus plus associated premium, yet may experience premium hesitancy. So we can do a financial underwriting and issue a pre-approval that's a high level that client can know, like they're gonna get the IFA, so we can get rid of the premium hesitancy. Second, clients are looking to increase the rate ROR of their estate. The third one is clients looking to facilitate the purchase of life insurance to invest in their own business for other investment. Identify the right client and how to broach the conversation. Assess their life insurance coverage gap. You need to think, are you working with a high net worth client? And you can discuss the new benefit of IFA, including premiums, collateral details, tax structure, and discuss the best way to structure their IFA that suits your client's needs. The last point is choose the right lender. For example, we offer the competitive rates. We have expertise in insurance lending, and we can always help you through the whole process. Incorporate IFA into your practice. Expand your knowledge in the insurance lending space and widen your clients' opportunities. Work closely with your lender. Get the professionalism you deserve. Work with the experienced insurance lending experts from sales to underwriting. Expand your clientele. Work with high net worth borrowers from personal to corporate applicants. And we always have our information listed on our website, and feel free to shoot us an email. We have such a great team.
Thank you. Again, I'm Michael Cumberbatch. I'm the head of business development and relationship management for deposits here at Equitable Bank. I'm going to give you a quick summary on our Equitable Bank reverse mortgage product. Talk about the reverse mortgage market, Equitable Bank solutions, a typical customer, and what makes Equitable Bank different in the marketplace. So looking at the market, there's been a lot of changes in the narrative around reverse mortgages. There was a single lender for a very long time, like over 3 decades. It was considered kind of a last option. It wasn't really thought of as something to use within a wealth strategy. Financial planners didn't recommend it, and the product was seen as being very difficult to enter and use. Fast forward, Equitable Bank entered the market in 2018. We've improved the features of the reverse mortgage. It's easier to use, far simpler to get in, get out. Financial planners are using it more in their wealth strategies to try to provide solutions for their clients, and homeowners are actually seeking them out. There's been a 40% growth in the market since 2022. As I'm saying, reverse mortgages are in demand. There's a desire for people to stay in the homes they've always lived in. As you know, Vancouver to Toronto, the cost of living has skyrocketed. Pensions versus cost of living are not meeting the needs of most clients. The returns on investments aren't compensating for that either. Retirement savings are not expected to last, and Canadians are living longer. So the combination of all of those things, reverse mortgages is becoming more of an option. This chart here kind of shows that the difficulty in accessing the market once you've retired. Like you can see, traditional mortgage market, there's like 20.3 million Canadians who have good financing options like a HELOC or line of credit. And then you can see on the other side, there's 9.3 million Canadians growing to like 4.6 million who have limited options for financing. So they're retired, living on fixed incomes. They don't qualify for the traditional lines of credit and mortgages and have to turn to another option for their financing, which is where the reverse mortgage comes in. As I was saying, a big thing is that 96% of people want to stay in their homes. And as Canadians are living longer, running out of money, they have to turn to different options. And then also, too, the value of homes have increased substantially, giving them another option to look at in their wealth strategy. So today's reverse mortgages are helping thousands of Canadians unlock wealth built up in their homes, providing access to cash for many different uses. So, I mean, when you look across the board, eliminating debt, taking free of tax-free monthly advances, down payments, gifts, early inheritance, helping out their children, their grandkids with either buying their own first home or dealing with debt from university or whatever. Also lifestyle too, as a retiree, maybe you haven't had a chance to travel, enjoy life, and now you want to maybe see the world. You may also want to renovate your home, fix your property. It could be other major purchases, maybe fund a wedding for one of your children. And then knock on wood, hopefully this doesn't happen to people, but there's unforeseen health experiences that could occur where you need an expensive surgery or treatment for a loved one. So there's a combination of reasons why you can look at unlocking this cash flow that's within your home. So let's look at the Equitable Bank reverse mortgage solutions. So there's three different types. We have first the Flex, our most popular. It's 55% loan to value. Minimum age is 55%. Or sorry, minimum age is 55. The fixed rate options are like 6.84 to 8.34%. So it's fixed plus prime. There's a drawdown options of having a lump sum, scheduled advances, or ad hoc as requested, or a combination. So for Flex and Flex Plus, you can use those options. Flex Plus goes up to 59% for the loan to value, and the minimum age is 70%. So as you can see, as you want to get a little bit more money, the requirement goes up in the age bracket from 55 to 70. And then a slightly better interest rate, or increasing the interest rate from 8.34 max to 8.79 and then plus prime. And then our last is Flex Lite, which is 40% LTV. Age goes back down to 55. This is just a one-time lump sum payment that you can draw from your mortgage. So we are eligible to sell reverse mortgages in Ontario, BC, Alberta, and Quebec, in all major medium centers. It has to be an owner-occupied principal residence. Homeowners need to be a minimum of 55 years of age to receive a reverse mortgage. The minimum property value is $250,000. So when is a reverse mortgage due? So there's a lot of different things going around about this, but I'll just explain it to you. Death or sale or transfer, the mortgage is due 180 days after death of the last borrower, 1 year after the last borrower moves into a long-term care or retirement facility. Knock on wood, we don't hope this happens, but upon default, failure to pay property taxes, maintain the home, insurance, or keep property in reasonable repair, then the mortgage would be due. Now we have, this is a great protection and feature that we offer. It's a no negative equity guarantee. As long as the borrower meets the mortgage obligations, the amount they pay will never exceed the fair market value of their home. So this is very important, that you'll never owe more than the value of your home. Also, there's spousal protection. In the event a spouse passes away, no requalification is required. Client cannot be asked to move or sell because of the loss of a loved one or their spouse. So how much can you receive? As you can see, it goes from 55 to 85. 55, you can get 15% at Flex. At 60, you get 30%. 65 goes to 32, and so forth. We have a very comprehensive calculator on the website that you can go through multiple scenarios and plug in different LTVs, age ranges, and see exactly what your client qualifies for. We have a great underwriting approach, so there's no credit bureau analysis required, no minimum score required. We accept the AVM is basically an automated home evaluation tool, as opposed to someone actually coming into your home to evaluate. The AVM is accepted in many cases for evaluating the home. As I said, we don't require income documents for clients with CPP and OAS. Applies to transactions with the highest Beacon score of 680. So in your submission notes, if you to like make these notifications, you don't have to provide any income documents. So during the funding process, it's very important to know that you do need independent legal advice required for every transaction, a closing lawyer, you need valid home insurance, POA if applicable, and must have the ability to deal with the real property. So let's look at a typical reverse mortgage customer. So age 75, home value is $1 million, credit limit or LTV is 400,000. You get an initial advance of 320,000, 80% drawdown. This could be used for debt consolidation or to help a loved one or medical expenses. Just going back to like separating fact from fiction, you know, people are retiring with 3 types of income, either Social Security, pensions, personal savings. 14% of Canadians will be retiring this year with an average of 272,000. And they probably estimate they need $1 million each. So there's going to be a gap in their funds that will have to be made up. And reverse mortgages are a great option. And now financial planners are actually looking at weaving that into their wealth practices to help their clients fill these gaps. So we have a great resource library and great customer service and a great onboarding approach. We have a huge Equitable Bank library with information on the product. We also have sample template emails that you can use and send out to your clients talking about our promotions. And again, there's the reverse mortgage calculator, which you can use to book time with clients and walk through different scenarios. We also have a D2C number that advisors can call, or so they can give their clients the D2C number and phone in to get an evaluation or a quote. We're also looking at building a website where you can actually go on and refer a client and enter the details. That I believe will be coming out in 2025 to simplify the process. So you put in the borrower 1 information, borrower 2, the property details, you put in the channel that you're from. So you're a wealth advisor from IDC World Source, and put in your details, and that will go straight to a D2C specialist. So we're excited about that. That's coming out soon in 2025 or hopefully in 2024, but stay tuned for more. I think I saw some questions pop up in there, Vic. I don't know if you want to go through those and we'll try our best to answer them.
Sure, yes, thank you. Can you all see the questions as well in the Q&A and chat? I believe you can, right?
Yep.
Yeah.
I know we already answered Dan Dean's question about the interest payment on an IFA. Johnny, I believe you answered that yes, confirmed. Monthly interest payments are required on an IFA. So I know we answered that one.
Yeah.
I did see a couple of questions about the actual presentation itself. So this particular presentation is being recorded by IDC. And as a result, we will be able to post this on our IDC WIN big website, and which is part of the IDC WIN website. So it'll definitely be there. I'm also usually, and I will for this one, I'm going to make sure it's in the Tuesday bulletin. We send out a bulletin on Tuesdays every week, and in the banking section near the top, I'll make sure that we have a link in there for that. So I know that was another at least 1 or 2 questions. And then perhaps you guys can address the questions that are left based on, let's go to the one Q&A.
I'm looking at that now,
Yeah.
Vic. So Scott's question was, what other underwriting is required, like credit score, net worth on all products? So Scott, it's a great question, and you're kind of answering the question in and of within your question, which is the amount of financial underwriting is kind of product specific. So if you recall from Mozzie's presentation, if we kind of go through the iteration, like Flex, there's really no financial underwriting because again, borrower has the option to capitalize interest. So like there are minimum credit scores kind of across the board, and we tend to look for 680 or above. 680 as a credit score is like nothing to write home about. So it's a pretty low threshold in and of itself. Moving on the insurance lending side to the max product, the financial underwriting involved there is just in terms of a view towards interest serviceability on the approval amount that the policy value itself would support. And then certainly going into the IFA, it's more intensive underwriting because, in general, we're talking about larger loan amounts. There is, again, often that, definitely in the first few years, an unsecured portion. But if you recall from Johnny's portion of the presentation, like there are different underwriting paths we can take. So what I would say is, in general, and I'll speak to kind of Michael's on the reverse mortgage side, as you saw more recently there, under REM's side, there is the ability, again, to capitalize interest. So there's not really huge financial, it's kind of a light touch to ensure this is, they just look like the right client for that product. What I would always say is, the real deep dive answer to your questions are probably best answered in the kind of one-on-one direct conversations, or really direct conversations around a particular opportunity. And that's where our focus on service and really engaging with you and you as the advisor and kind of your client through you to provide all these in-depth questions, right? So Scott, I might imagine, you can reach out to myself, again, Mozzie, Johnny, whomever on the team, and you might say like, hey, I have an opportunity. We'll say like, okay, what's the client looking for? And then we'll be able to narrow it down to the best product solution. And then we can start answering some of these more detailed questions. I see Edmund Innes popped into the Q&A part. So he's saying, are NOAs or any other tax documents required year over year in order to continue IFA funding over time? So Edmund, the answer to the question is, the plan is not every year. So if you call the one slide, and again, we will provide, I know Vic said there's a recording. I'll send Vic a PDF copy of this presentation for broader distribution as well. But within the one slide, like the intent is not on the IFA to really financially underwrite or even frankly look at everything year over year over year. The plan is to have the heaviest lift on the IFA at year one. A really more expectation that it's a pro forma kind of, I'm not overly smart, so I use simple words, kind of a rubber stamp process, ideally in years 2 and 3. We do expect, and the expectation should very much be at the fourth policy year, that their client will be asked to submit more recent updated financials. And then we would flip back to that kind of more pro forma rubber stamp process. Now, we, like any other lender, quite frankly, reserve the right to ask for updated financials whenever we see fit. But we would only expect to, in those off years, as I call it, kind of years 2, 3, 5, 6, 7, 8, 9, and on, only if there's really an indication of financial stress on the borrower's side. And those drivers were listed off, and Johnny touched on them. And those are kind of large drops in credit score. They didn't pay their premium on time, or they missed interest payments to us in the preceding year. I think all three are reasonable expectations. I always find it helpful, and I always say, it's always helpful to put yourself in the other person's shoes. So like, pretend you're the one with all the money and looking to lend out money to individuals. What kind of things would you look for before, to be comfortable kind of extending more and more money to someone? Sorry, I'll keep going because I'm on a roll.
Yeah, go ahead, Mike.
I handed over presentation skills, but listening to everyone talk, I felt like I wanted to talk again. Edward Turgeon just jumped in. Is there any ongoing annual fee on the IFA or just on the application? So, Edward, there is the initial application fee, which is kind of that minimum 1,000 or 25 basis points multiplied by the single year total annual premium. Hence, 400,000 annual premium or less, it's $1,000 app fee. The annual fee, if you will, that reverts back to just a flat $500. In Johnny's portion, we refer to that as the credit limit increase fee. Now that fee is, in effect, you can think of it as annual, because in the IFA, the expectation is, the client's going to pay a premium, borrow back, and kind of constantly re-engage year over year. That $500 flat fee is just a flat $500 fee, regardless of the actual annual premium amount. But it is also only well and truly charged in those years where the client is in fact engaging with us looking to borrow back. Now, by structure and expectation, if you will, on an IFA, say it's a 10 premium payment schedule, you would expect to kind of pay call it the 1,000 or 25 basis fee at year one, and then the following 9 years pay the flat 500. However, we want the clients to re-engage. We want them to borrow more and more money. We know anecdotally, clients may in fact not feel the need or have the desire to borrow back another year's premium. So if they don't, let's say they kind of borrow back 3-4 times in the 5th year, they just decide to pay that out of pocket. They don't need to borrow it back from us. They're not going to engage with us. No fee paid in that instance, obviously, because they're not dealing with us.
Mike, I'll just add one comment, actually. Maybe going back more to Scott's initial question, although I picked up on this theme in a couple of the other questions as well as your answers. What we are dealing with here, just to take a step back strategically, is non-mortgage lending. And I want to make this point maybe as bluntly as I can. This is custom credit. It's not mortgage lending where the Bank of Canada, Department of Finance, OSFI, CMHC, all the regulators have prescribed in almost ridiculous detail exactly what boxes a lender needs to check for a mortgage to get approved. And it's quite onerous. This is going to be, not a walk through the park. However, there is a lot of room for negotiation and flexibility. You don't have OSFI breathing down your neck all the time, on every little detail. So this is why there's some flexibility, and that flexibility works in two ways. It can be positive in terms of the benefit to the client, getting the deal they are hoping for. However, there's also going to be responsibilities with that, and the lender may require, of course, follow-ups, additional documents as Michael requested, as suggested, 3 years, 4 years later.
Okay. That's the end of the questions I saw in the Q&A. So I'll flip over to the chat and I'll do my best to address some of the points there. So first off there, I see Mark asked, so your question is, are you able to refer residential and commercial mortgages directly to us? I will say yes and no in the sense of it depends on it. So what I always say, I like to stay in my lane. Many times I'll talk to an advisor and they'll have a question about a commercial, hey, my client's bigger in commercial real estate, or my client's, just wants to talk about a mortgage. What I do in those instances is I just connect that advisor with quote unquote my counterpart in that side of the business. So if it's a residential mortgage, I'll connect you with our someone on our we call it SFR, single family residential team. On the commercial side, I'll connect you with someone on the commercial side. And really, they are the product expertise for their own product, so they can talk to you about it. I would say, by and large, expectation is there's no formal kind of, certainly on the commercial side, referral fee. But, again, I would leave it up to my counterparts to answer those questions for you, specific to their product lines.
And Mike, we only have 2 minutes. Can you just take a shot at maybe the ones that are left as quickly as you can? They're mainly IFAs.
Client can convert to. Okay, so how Lee asked, if the client gets a CSV max at age 45, can they convert max to CSV flex when they reach age 50? So the question, basically what I would say is, we are always open to clients moving from one product to another. However, it needs to make sense. So I would say it's we're happy to look at it. Specifically to your question, though, how it's unlikely that the client's going to be able to do it, right? Because if they're taking kind of targeting 90% LTV at age 45, increasing at 46, 47, 48, just because they turn age 50 and are now age eligible for flex. Flex, the way we underwrite it, if you recall from Mozzie's kind of the two sloping curve slide, Flex in general approves at a lower loan to value because we are accounting for the fact and must account for the fact that clients can capitalize the interest. However, it's not to say anything's out of the question, right? We will always do it, right? Because often the question is, hey, if I start with an IFA, can my client switch to Flex? Like, yes or no? We will let you know. It's always nothing's ruled out. We're happy to look at it. And again, kind of I'd say, long-winded way of saying on a case-by-case basis, sure. Please clarify re-IFAs, interest must be paid monthly. Correct. So
Yeah.
interest must be serviced on both the IFAs and that CSV Max product on a monthly basis. So it's really somewhat related in that question is obviously interest is only charged and due on actual borrowed amount. And so that's a point of clarification with, let's say, Max. Client might have access to, it's a large policy, so might have access to $900,000. They're only borrowing $50,000 quite clearly, or just to confirm quite clearly, they're only going to pay interest on the $50,000 that they borrowed. If the client.
Do you want to look at how do we get compensated for business sent your way? I don't know.
Yeah, we didn't cover that at all in the slides, and I was going to comment on that. So there is compensation for you on the existing policies that are in place, but not on IFAs. Traditionally, there is no compensation for anything that is a new sale, whether it's a new seg fund or a new insurance policy. And there is also compensation on the reverse mortgages, as well as we do have residential mortgages built in to that contract as well. We may not have enough time to cover everything here, but we can certainly follow up on this. But gentlemen, take your perhaps minute that you have left here to address the exact amounts of compensation, please.
Sure.
I can speak quickly to reverse mortgage. It's 24 basis points on the funded amount of a reverse mortgage, and then there's a volume bonus of 10 million if you reach that threshold, where you get an additional 10 basis points.
Okay. And then to Vic's point, on the insurance lending side, there is no advisor comp with regards to the IFA product for two reasons. I always say, one, the amount of comp we might make available would be kind of a rounding error. We see the comp, really you're earning the comp via the insurance sale. And also, who's kidding who? Anytime there's advisor comp available, it's built into the rate or the product itself. So effectively, we're just going to charge the client more to pay you. So what that also allows us is greater flexibility on rate when it comes to the IFA. On the CSV Max and CSV Flex product, there's effectively what amounts to a 20 basis point trailer payable to the advisor on borrowed dollar amounts. And then just very quickly, just to round out the answers to some of the chat, there was a question about London Life policies. Johnny did answer it. So John, London Life policies, old Great-West Life labeled policies, like they're all basically rolled into the Canada Life umbrella. So certainly they're available there. And then there was a question, if you're not the servicing agent or the agent of record on a policy, can you still refer the owner of the policy to Equitable Bank? And the answer is yes, right? We require the advisor to kind of sign an advisor agreement with us. It's quote unquote you getting contracted. And then any deals you send to us would be that. What I would suggest, though, is it makes it easier if you are the servicing advisor or the agent of record, because part of all application processes and certainly all, frankly, the initial discussion is we will always want and require, policy information so we can review it and answer some of those things like how much would this policy support in terms of an approval amount if it's on the IFA side? Is this a good structure? Can I get to 100%? What would the starting rate be? All those things. Again, you do not need to be the agent of record or the servicing agent, but it's certainly helpful, in terms of like accessing the policy info that we would want from the insurance company. And
Mike.
I think we are very good. I will say personally, only being 3 minutes over is by far a personal record for me. And that's largely because I didn't talk a lot until the end, which pushed us over 3 minutes. But I want to thank you all very much.
Mike, thank you. Mike, Mozzie, Johnny, and Michael. This has been fantastic. I want to thank you for putting together such a great panel for us. This is the way we're going to keep doing it with you. Just based on the questions alone, there's strong interest. We're going to do this again as soon as we can, probably early in the new year. So again, my sincerest thanks, and we'll have this recording up as soon as possible, everyone. Any last closing words, or are you all good?
No,
Happy
thanks,
Appreciate you
selling,
guys.
everyone.
thanks for putting this together. It was great to work with you and your team, and we look forward to doing business together.
All right. Thank you very much, Michael. Okay, everyone, enjoy the rest of your year. Call me anytime. I'm here to work with all the bank partners. We always have to have a plan B. So in any of these situations, whether it's IFA or reverse, I'm here to make sure that we don't leave anything on the table when it comes to lending or banking. Thank you very much and reach out anytime. Bye-bye, everyone.
Thanks again, everyone. Bye-bye.
Bye.